perhaps you can take us through an investment idea from start, the initial idea generation, through to implementation in the portfolio. Give our listeners an idea of how that whole process works from start to finish.
Sure. Maybe one that's a bit of a sort of a growth cyclical. We had a position in Siltronic, and of course, everybody wants to talk about their winners, so I'll give you a winner. But I caution you, there have been many losers over the years. But one business, a German company called Siltronic, was very good to us, I think, about 3 years ago, and it was a perfect kind of setup for Apus. It was spun out of a German chemical company called Barker CFA, and it was a company that makes silicon wafers. So they compete with Global Wafers, they compete with MEMC, which is now part of Global Wafers, Sumco, Shin-Etsu, LG Siltron. So we know the semiconductor wafer space really well, and we've invested in that space. It's cyclical, but it has its moments. It's having one of its moments now. It's a very attractive sector, and these are making the raw wafers, the 6-inch, the 8-inch, the 12-inch wafers that are used to fabricate circuits, semiconductors. And Siltronic is a 15% type player, I would say, maybe in that 15 to 20% of the global market. The Japanese are very strong. There's, like I say, a couple Taiwanese that are strong, but it's a nice oligopoly. Like I say, 5, 6 main players. And when Siltronic was spun out of Wacker, it's the only semiconductor wafer company in Europe. And it was covered initially by German chemicals analysts because, they covered Wacker. And so this thing came public, and we were watching the semiconductor cycle get much healthier, and we had a kind of feel for how strong the earnings power can be in an upcycle for this sector. And so we did our work on Siltronic, and we came up with our numbers, and I think it was a 40 euro stock, and we had them earning about 9 euros of earnings. And when we looked at the street, which was, like I say, a couple of German analysts who cover chemicals, they had 4 as the earnings. So they had it on 10 times earnings, and we had it on, less than 4 times earnings. Now, in the end, we were wrong. It was actually, they made about 12 that year, so we were too low. It was really on less than 3 or about 3 times earnings, I guess. But the whole point of that discussion was that we could understand. I mean, again, to make money, you got to be different and you got to be right. I think that it's not that hard, but a contrarian view, or we call it, we want to be violently contrarian, and it's just way different. When we're way different from the street, if there's a street consensus, and we're arrogant enough to believe that we're right, that's where you're really going to make your money. And so when we're at 9 and they're at 4, and we know why they're at 4, we understand why they're at 4, and we're really confident they're wrong and we're right. Those can be what we call core ideas. Those can be ideas that, for us as a 5 to 10% position, the core, what we call these core ideas. And so when we're arrogant enough to believe that we're right and have that high conviction, and we don't get, our whole model is if you get 3 or 4 of these a year, you're going to do great. If you have a 7% position that doubles, you just made 7%. And if you get 2 or 3 of those, you've had a great year. And so that's kind of the model of Apus. And so for Siltronic, we bought and we made it a core position. I think it went from 40 to about 160, and of course, as we talked about earlier, we sold on the way up and didn't necessarily top ticket and certainly didn't bottom ticket. But all that's part of a process too of doing your work, building a position, getting more conviction, adding to the position, seeing the stars come into alignment, continuing to add to the position as it does that, and then having the pragmatism to say like, okay, is this now in the price now? Several analysts are covering it, and their earnings have gone from 4 to 12, and of course now they're going to project 16 for the year after. and we're kind of nervous. We no longer have an edge. Or maybe 16 we think is a bit too high, because these are cyclical. And while they're sort of growth cyclicals, kind of stocks that I guess you rent rather than own to some degree, or you have to at least keep them on a more short. Keep an eye, I guess, on the cycle itself, because that's going to drive the stock performance. And so, I don't, like I said, I don't remember exactly where we got in and where exactly we got out, and I know we didn't execute perfectly, but I know we were out sort of back in the low hundreds, and I think it then fell again to about 60 as a share price, and of course it's done well again in this most recent semiconductor cycle. So again, that sort of plays to our advantages. We know the Asians. We understood why the Europeans were kind of, we call it the locals don't get it. It's sort of one of these areas where we get value, and that sometimes they have this great situation. It's right in front of their nose, but they don't appreciate it because they can't see the bigger picture. They've never looked at semiconductor, wafer stocks in the past, and said we have, so we could bring that Asian perspective over to this European company and get an edge in it.
Very good. So you talked a little bit about selling on the way up. So obviously taking profits is part of your sell discipline. Mm-hmm. Are there any other elements to your sell discipline, particularly on the risk management side when things go wrong? How do you make that decision that it's time to cut bait and move on to another idea?
You're always, what I love about this game is you're always getting feedback every day. And, it's like you take a test, you don't look at the ones you get right, you look at the ones you got wrong, and that's what you're going to learn from. And that's, every day you see things you're getting wrong, and you're looking at that and trying to understand those reasons why you're wrong. I think this is where you get into the art of investing. It's, there's an element of, if I don't understand why it's not working, certainly you see things and it sticks out like a sore thumb if it's not working. It's not easy to get that subset of stocks that are giving you problems. But then you go through them name by name and try to understand, what am I missing? What have we got wrong? And if you can understand that and you can get comfortable with that, then, those may be situations where you can be contrarian and buy. And maybe it is just, a risk-off episode or a sector rotation or, one of these episodic, retail investors have lost their minds kind of thing, where you can really take advantage of those types of situations. But also you have to be pragmatic. I mean, this is small cap. You're going to get things wrong. There's why I'm still here after 30 years, is that ability to keep my humility, to understand, that when you're wrong or when you can't explain, you probably, and we're very incremental on what we do. It is not, you don't see us whipping it around in terms of, our exposures and stocks. And when it's not working, we're starving it or we're reducing it. When it is working, we're probably incrementally adding to it or feeding it. So sort of feed your winners, starve your losers is sort of, the approach we have. So when you're wrong, that's a good reason to sell. I mean, there are times where you're just flat wrong, and it's not, if you're honest with yourself, it's pretty easy to see. That's a good reason to sell. I think when you have better ideas, there's a lot of, kind of internal competition for capital. We have what we call a monthly rebuy the portfolio meeting. And it's really just start with EAs on the long side. Remind me again, why do we own this? Okay, let's look at this portfolio. I've got a large position and our price target is only 5% upside. Whereas I've got this much smaller position with 50% upside. Let's have that discussion as a team. Maybe we should, and again, a lot of things just happen out of inertia in a portfolio, and you just let things work. And then, you need to stop at a point in time and say, okay, is this the portfolio? If I just had cash today, is this the portfolio I would want? Is this the optimal portfolio? And so there's a lot of, when we come out of our monthly meeting, there are several, trim positions, candidates, or maybe even outright, sells. If we can't push the numbers anymore and it's already at our price target, we can't dream in the most optimistic scenario that this could get any better. Yeah, it can just be, we have better ideas. We have ideas which have, more upside, that are more compelling, and there's this competition for capital. And so that can be another reason that you sell a position. Yeah, I mean, I'm trying to think of other. It's just, you just can't push the valuation anymore. You're wrong. Those are the main reasons. But I think that there's so much behavioral in all of that. There's so much of, again, I think just doing it, I don't know, I always think being from the Midwest, we have a reputation for just having a lot of common sense and not being too full of ourselves. And so, I think that plays into hopefully our strengths that we can admit when we're wrong, and move on.
And as you're looking at the stocks in your portfolio, how are you thinking about position sizing? Obviously, it would be different across the three funds, but in broad terms.
No, in broad terms, we do have the same approach across the funds. We have this concept of what we call farm, research, and core. And the idea of farm, research, and core is that, we created this, what we call farm team, because we kept finding, we used to work with these enormous watch lists, and we sort of, we're big believers in terms of whoever turns over the most rocks wins, that sort of Peter Lynch principle. And so just meet businesses, meet companies, learn about their industries, learn about their particular businesses, and you're just going to start to naturally kind of connect dots and start to put things together and over time. So, but what we would, again, this is a behavioral, I guess, challenge, is that what do you do with a watch list? You watch it, and that, like you being an allocator looking at fund managers, if you have an investment with a fund manager, I guarantee you're going to look more closely at that fund manager than some guy that you met once and you were curious and you probably weren't going to invest with him, but you keep tabs on him or whatever. But when you own it, suddenly, okay, I'm feeling it. And again, for our farm team is a sub 1% position. No note, no model. I'm the PM. I'm the decision maker, but our analysts could come to me and say, "Hey, Dan, I think this is interesting. I still have some work to do. These are some questions I have, but it's timely. Let's get something started." And just based on my experience, sure, let's do 50 basis points. Let's do up to 1%. Now, to grow it to the research portfolio, which is a 1 to 5% position, full note, full model, at least two people on the team agree. So we got a larger consensus on the team, and we're developing, it's a lot of times, and it's okay. In the farm team, you do the work, and you're like, I found some hair on this, there was something I can't get comfortable with, or it's not as, I'm not building the really strong contrarian view that I had hoped I'd buy. That's okay. Kick it out. So there is this kind of churn, and maybe 10% of the portfolio is typically in what we call the farm team. The bulk of the portfolio is in that 1 to 4% range, maybe, or 50% of the portfolio, 60% of the portfolio, where these are 1 to 5% positions. Again, full note, full model. We have a contrarian view. It may not be perfect. It may have liquidity or other risk constraints that sort of keep it in that 1 to 5 bucket. It may not be necessarily as timely, or the timing isn't necessarily perfect, but we really like it. It's a solid idea. We have edge. We have an argument with the market. We have conviction. It's gone through our diligence process. That can be a research position. And then to go core, which again is sort of these, like the Siltronic example I gave you, is sort of these 5% plus positions, full note, full model, actually consensus of the team. There's not, Eric, my partner at Apis, is I require his agreement on anything that's going to be a core position, because these are going to be the big movers. These can hurt or help, hopefully help, the portfolio. But we really have this, like I said, we're at 9, the street's at 4. We know why they're at 4. We know why we're at 9. We're right, they're wrong. We're gonna make that a big position. So those are what we call our core ideas, and those might be our top 10 positions are probably 40-50% of the fund. So at the top, these are 7-8% positions. At the bottom, they're maybe 3% positions. But those 3 or 4 or 5 core names, hopefully that we have are 5 to 10% type positions, and in total, they might, those 4 or 5 names might be 30-40% of the portfolio. I should say, if they average to sort of 6-7% positions, if you have 5 of those, that's 30% or whatever of the portfolio. So it's kind of a blend of, there is this tail of names, but there's also, these core high conviction ideas that kind of give you a little bit of that concentrated portfolio while having a kind of well diversified, tail of names as well.
And when a stock makes that core allocation, how long would you typically own it for? What would be your usual investment horizon for a well-researched core position that you've got strong team consensus on?
Yeah, and there's a nuance to that. I mean, I can give you the mathematical answer. I think is the average holding period has been about 3.5 years for a position like that. But there is some, that Siltronic was probably 1.5 years type of position. And that was because it was a little bit more of a cyclical story. There was a moment in time where we had a lot of edge, and that got closed pretty quickly. So, and that's okay. It can then go from core back to research, or, even in some cases it goes back to farm, because the timing isn't right, or, what the thesis has largely played out, or it goes out, entirely. So, but the ideal is to have, we've had a few of these where they've been almost for the entire existence of APIS, where we've owned a company for 15 years. It's been a multi, bagger over that period of time. And the goal is to, find those that can do that. So I will say too, I think just as a small cap investor, you can't bet on the quarter, and you can't be short term. You actually, it's a requirement that you look out 3 to 5 years, and you think, okay, this business will still be a good business in 3 to 5 years, because you don't know when you're going to get paid in that spectrum. A lot of times in small cap, you can kind of be the proverbial, tree in the forest or whatever, and it's doing great. It's executing fundamentally just the way you'd hoped, and nobody cares, and nobody's paying any attention to it. And but then for some mysterious reason, the spotlight maybe comes to that segment of the market, and you're like, duh, where have you been all my life? It's about time, and you get a very significant re-rating in a short period of time. And so I think if you're playing, just because you think, hey, this is going to have a good situation short term, they may have a great quarter and the stock does nothing. About the time frame for small cap investing, yes, and sort of the 3 to 5 year view. Yeah, and like I say, I think you just hope that somewhere along that, if you have that perspective, you hope in that time frame that someone will notice what you've noticed, as long as you have that longer term view. But hoping that they'll see what you see imminently is probably, potentially asking for too much.
Mm-hmm. Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.